We think it's actually hugely positive. The implicit assumption is a professional manager, so I would distinguish that from a founder like Mark Zuckerberg, is stupid. That they are going to spend $50 billion extra dollars with no contracts and no returns. Well, it's actually almost certainly the reverse. That if you are sitting there with your CapEx budget and say, oh, we have to spend $50 billion more, well, you're going to charge your customers a lot more. And you even saw it last night. When you report earnings, you're going to blow out your earnings and have huge cash flow. So we're assuming basically that these managers are completely stupid, and they're clearly not.
So, Jay, I agree that, a lot of these stocks, specifically some of the tech-oriented ones, and in financials, I mean, KKR, I know you like Marvell, but value-oriented equities are up 1.2% year-to-date. They've outperformed growth. I think growth is down something on the order of 2.83% through the first 2.5 months of this year. And, I just am curious to hear, is now the time to be, bottom feeding in growth, or do you want to lean more into, industrials and materials and some of these more pro-cyclical sectors?
Well, it's of course all confused by the war, but actually the war is more bullish for tech, because what was happening is there's a rotation driven by Fed rate cuts out of what is perceived at least as defensive, which is tech. So the companies that we traffic more in, like ICAP and all of our funds, which are income value stocks, have done really well this year. But we think it got overdone. I mean, we pick on Walmart trading at 44 times and Amazon at 20
Why
times. So we think that got stretched too far. And now the Fed is clearly on hold until we get oil below 70. So actually that rotation is likely to end, and you're going to get more rotation into tech. So we think it's a good time to go to these stocks. Particularly Amazon is a low beta, so you're not making a huge bet on the market. Or Marvell just blew out their earnings, so there's no risk there. Same thing with Broadcom. So great companies, huge growth.
Right.
People got way too bearish about particularly tech infrastructure, in our opinion.
It was a wonderful way to start the 7 o'clock hour. Jay Hatfield with us, Infrastructure Capital Management. Lindsay Rosner coming up here in about 3 minutes, and then Lisa Shallot will be with us as well. A great lineup today. Mr. Hatfield, you are a student of history. I would suggest my reading of history is select equities benefit from war. Nobody wants to talk about it because we have, men and women in harm's way. I looked at 3 minesweepers out of Bahrain today. It's frightening what those things are doing, floating around in the water. But equities can benefit out of war. Am I right on that?
Absolutely, and we actually do manage equities that benefit in our AMZA ETF. We have pipeline companies. They did terribly last year. They have great fundamentals, and they also have low betas. So, in our picks, we said had 3 high-risk ones and 3 low-risk ones. So pipelines is a low-risk way to play that.
Let me wrap up here quickly. In the hierarchy of the market, bringing it over to something as simple as real GDP. Do you dampen real GDP given these global stresses?
Not yet. We think that this is going to resolve itself in the next couple of weeks, and we'll get oil below 70. So we haven't redone all of our forecasts, but it is an unmitigated disaster if oil stays at $90 a barrel, and then we'd have to revise our inflation forecast, GDP, and everything.